Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really happy to tell you that John Rubino is with us again. He's the creator of the popular website dollarcollapse.com, well, he's here to fill in for Lynn Alden, who, due to some family issues, wasn't able to be with us today. But as I said in my introduction, I don't think there's too many people that can do better at answering the question that we have in our minds today than John Rubino, and the one we were going to ask Lynn Alden, which was, where can we hide from the financial storm heading our way in 2023? And well, certainly, perhaps one hint can be seen in the market activities today. Let's hear what John has to say. Thanks for joining me again, John.
Hey, Jay. Yeah, it's been an eventful couple of weeks in our little corner of the world, huh?
Well, yes, and it hasn't all been all that great, but today things are looking up for those of us who believe in real money, honest money, not the fake counterfeit stuff that we're forced to use at the point of a gun by governments around the world. What gives, John? Why the explosion? I would call it almost an explosion. $30 up in gold, but silver even more so. 5.16% in the cash market as I'm looking at it right now, to $24.15 on the bid. Something happened over in Japan, I believe, perhaps, that might have set things off in a different direction today.
Yeah, there are a lot of things pointing in a good direction for precious metals, but the immediate catalyst for what's happening today was the Bank of Japan kind of semi-capitulating. Basically, the longer term story for Japan is that the Japanese government has been borrowing insane amounts of money to try to prop up an economy that's full of zombie companies and people who are near bankruptcy and everything. And they've been able to get away with it for quite a while by just pegging interest rates at extremely low levels, so the government borrowing didn't really cost anything. But with inflation picking up, the pressure, the selling pressure on 0% bonds has become so intense that the Japanese central bank hasn't been able to peg the interest rate at zero anymore, and they had to let it go up to 0.25% for a while. And that didn't work, and now they've had to expand their band to 0.5%. Now, the problem with that from Japan's point of view is that when interest rates go up, their interest costs go up. All the Japanese debt that has to be borrowed right now or rolled over does so at a higher rate, and that increases the interest costs for the Japanese government, which makes their deficit even bigger, which starts them on kind of a death spiral where they're borrowing more and more at higher and higher rates, and there's no way out of that. Now, they aren't quite there yet, but they're moving in that direction. And today's, like I said, semi-capitulation, where they let the rate go up to 0.5%, is a big step on that path. And that spooked the global financial markets because Japan has been kind of, they've got these debt-related problems that everybody knows about, but they've also handled those problems very well. And if they can't handle their massive government debt, then everybody's wondering who else can't. And of course, the U.S. is on that list. We've got basically the same problem as Japan, only we're further along because our interest rates are already higher than the Japanese rates are. So we in the U.S. are looking at, as the government's debt rolls over at higher and higher rates, another $500 billion or so in government spending just on interest.
Yeah.
And it goes on from there. As more and more debt rolls over, our interest costs go up, our deficits go up. And eventually the pressure of all of that, those imbalances ends up on the currency and forces the value of the currency down. In our case, already the dollar lost 10% of its value in the last year. And there's no reason to think that as we continue to borrow more and more money and then refinance what we've borrowed at higher and higher rates, that won't continue. This is a legit death spiral for the world's fiat currencies. And Japan just kind of illustrated that point for everybody.
Yeah, I mean, David Stockman pointed out that our debt service coverage has gone up, the expense has gone up by 43% over last year at this time. 43%, and taking in, almost spending about twice as much as we're taking in revenues right now. So how does that play out? And It's you have to wonder if, John, if to a certain extent part of the equation also has to do with the currencies, because the dollar has, the Fed has been aggressive in raising rates compared to other countries and other central banks, and just to keep the yen from spiraling out of, into the dustbin of history right away. Maybe a part of the reason was also not only to lower part of the reason would also be to defend the currency, possibly. I don't know. What do you think?
Well, that's the dynamic
Yeah.
when you run bigger and bigger deficits and pump more and more money out into the system, that lowers the value of your currency. It puts downward pressure on its foreign exchange rate. And that's what's happening with the yen. The yen went from about 100 yen to the dollar year and a half ago to 140 just lately. In other words, its value fell by 40% versus the dollar. That's not the kind of thing that you can allow to continue, because that means everything that you import goes up in cost.
Mm-hmm.
That means you have inflation, which makes the currency even less valuable. And so that's the kind of self-reinforcing feedback loop that Japan is in now. But really, everybody's in it. There's no major country, with the possible exception of Russia, whose finances aren't almost as bad as Japan's. So everybody is kind of tipping into this same abyss right now, with no real way to fix any of this, because you got a lot of speculation out there of what the Fed is going to do. Are they going to generate a deep recession or a soft landing? And really, that is completely meaningless, because nothing that they're doing will fix the underlying problem,
Right.
which is exponentially increasing debt. And so no matter what happens next year, maybe we have, 3% growth and 2% inflation next year, and everybody thinks everything's fixed, but it won't be, because we will be borrowing ever increasing amounts of money, making our problem even worse. So we're working on the symptoms right now. But the underlying disease is progressing, and it's terminal. There's no way you survive in the current form with the financial disease that we now suffer from. So it's going to end up killing the fiat currency / fractional reserve banking system at some point. And it could well be next year. It could be a 2023 story when this stuff just all blows up on us.
Yeah, I was going to say terminal when, it's like, how long will the respirator keep the patient alive is the question, I guess. And respirators can keep in humans alive for a long time, but they're virtually dead. And I guess that's where the zombies come in. The zombie companies have been kept alive in the United States. Japan, no doubt, worse, because they've been at it, this quantitative easing, for much longer than the United States has. But it is, yeah. And you have to wonder, and we were talking to Michael about this before you came on, the idea that, that it could be that the metals just absolutely go berserk on the upside at some point, like markets do from time to time. I mean, natural gas, as Michael pointed out, went from $2 to $9, in about 6 months or whatever. I mean, sometimes if confidence is lost in the fiat currency and this global fiat system, which I believe, John, is the first time in history that we've had every country around the world off of some sort of a gold or silver standard. Over the last, since 1971 anyway, it's basically everybody's gone off of any kind of honest monetary regime, right?
Yeah. Since 1971, the world has basically gone to, make-believe money standard, fiat currencies, where the dollar and the euro and the yen, et cetera, are only worth what they say it's worth. And we only value those currencies because we trust the people running them. When that trust goes away, then there's no intrinsic value there. Like somebody handling your gold for you can get into some kind of trouble, but your gold is still valuable. But that's not the case with dollars. If the guys managing the dollar system turn out to be untrustworthy or incompetent or some other thing that scares you, then the value of the dollars that they're managing for you just disappear. And that's kind of where we are right now. We're at the point where capital is starting to flow into real things and out of financial things because we don't trust the financial assets that depend for their value on fiat currencies. So you're seeing central banks of the world become net buyers of gold pretty aggressively too. And if you look at the metals exchanges where silver trades, physical silver is being taken off at an increasing rate. And some people now are predicting that, for instance, the COMEX will run out of physical silver to be able to make good on futures contracts sometime in the coming spring. That we're that close to a default on a major metals exchange for silver. And this was always inevitable. Stuff like this was always going to happen in one form or another, but at long last, it is starting to happen. And you're right, it's incredibly good for precious metals prices just because more and more people are figuring out that sound money, real money, is a very different thing from the currencies that we use right now. And they want that real money. But there's nowhere near enough of it to satisfy the kind of demand. Let's say 2% of global investable capital tried to flow into precious metals. It wouldn't be able to do it. There is not enough gold and silver out there that's available for sale to satisfy that kind of demand. And that's just like 2%. I think it'll be very common for people to want 10% of their capital to be invested in precious metals in the not too distant future. Yeah. But of course, they can want that, but by then they won't be able to. And that means precious metals prices go straight up in that kind of a circumstance, right? We've seen, like you said, a lot of other things do that. Bitcoin did it. A lot of industrial commodities just went straight up in the last few years. Well, gold and silver are arguably a lot more legit safe haven assets than anything else. So you're going to see more demand and more long-lasting demand for them when the time comes.
Yeah. Well, you wonder. You mentioned the COMEX or the silver in the exchanges of. They're being drawn down dramatically. And of course, if people lose confidence in the paper system, then they don't want paper derivatives of those things. They want to have the actual metal in their possession. And if that happens, then there's not enough metal there to cover all of the paper. The derivatives, the futures markets and the ETFs and so forth that are out there, right? If people really want to take possession of gold and silver, it's got who knows where it goes. And as you said, 2%. If just 2% of the people wanted gold and silver, well, at some point, in theory at least, everybody could have gold and silver. But what price would it have to go to?
Well, actually, it would change hands. So everybody wouldn't have it. It would be people selling at a very high price to somebody else.
Right.
Who holds it at that very high price. And so, yeah.
But selling it for what, John? Selling it for paper that nobody has confidence in.
Yes, that's the thing. Why would you sell into those circumstances? It would have to be one hell of a price in paper, right? And you would have to then swap that paper over into some other real asset that hadn't yet appreciated. Say silver goes up by 1,000%,
right?
And farmland is up by 100%. You can swap your silver for farmland, right? With using dollars as an intermediary, and be okay. But it's not going to be a case where you think, I think dollars are an attractive buy right now. Let me cash my silver out just to own dollars. That there will be a time when that does not happen at all.
Yeah,
and I think that time might be coming soon.
Well, that time might be coming, but there are those like we had last week, Keith Weiner, for example, of Monetary Metals, the dollar milkshake theory, which I imagine you're aware of that line of thinking. Brent Johnson, I think, is the person that's made it popular. He's been a guest on Adam Taggart's Wealthion show, and the idea is that that the United States having the senior currency, and since there's so much debt around the world, whenever the Fed does what it's doing now, starting to contract, then there's people scampering for dollars because they have dollar debt service obligations that they have to meet, and they go out there and bid up the price of the dollar. So the dollar has been relatively strong compared to other currencies. Of course, they're all fake, all fiat currencies, and are manufactured with debt, and they're not real money. So there's that idea, and so when does the system go down is the question. And I guess it's all about confidence, isn't it? It's a con game, essentially.
Well, with fiat currencies, yeah, it
Yeah,
is absolutely all about confidence because there's no there's no reality
yeah, yeah.
um, to um, to hold on to with a fiat currency. And yeah, the last year has been fascinating from the point of view of the dollar because we had, let's say, 10% inflation. It's probably higher than that in the past year. In other words, the dollar lost 10% of its value measured by its purchasing power, which is the
Right.
real way you measure it. And yet it went up versus the yen and the euro and most other currencies. So from that point of view versus the other fiat currencies, it was strong.
Hmm.
So the question is, which of those valuation methods do you look at and give credence to? And obviously, the purchasing power of a currency is the real way you value it. The dollar lost 10% of its value in the last year. It was not a strong currency.
Yeah.
But the yen and the euro were even weaker currencies. That's how you look at this.
Hmm.
And what did the dollar lose 10% against? Most of the stuff that you buy for your normal life and real assets
Hmm.
like industrial commodities and gold and silver.
Hmm.
And over time, as that continues, people are going to stop caring what the dollar is worth versus euros and yen because the euros and yen are not really worth much of anything either. And they're going to look at real stuff. And we're seeing that now because the demand for a lot of real things is going up. But we're nowhere near the critical mass point where market psychology completely shifts over to dump your financial assets and buy real assets. But that day is coming. As government debts go parabolic, which they are doing right now, and that starts to lead to either higher inflation, in other words, falling purchasing power for currencies, or just exploding deficits.
Hmm.
You reach a point where the conventional wisdom is that we can't trust these currencies anymore, and we need to bail and get into real money. In the past, when you and I have talked about this, that was somewhere in the indeterminate future. But the Japanese thing kind of implies that it's much closer now than just someday. It's within a few years, if not the next year, when a big phase change happens in market psychology.
Okay, well, on your notes that you sent to me, you were convinced that we're heading into a recession in 2023. Perhaps give us your argument on that. Tell us why.
We raised interest rates really dramatically in the face of the inflation that we've seen in the last year. And that's hitting home now. Houses. we were in a housing bubble the last couple of years in the U.S. When home prices were just going up year after year after year. And part of the reason for that was because mortgage rates were like 2.5%, 3%. So you could buy an expensive house with very cheap money and still afford it. But now mortgage rates have gone up to 6 or 7%, which means the house that you might have bought 2 years ago will now cost you literally twice as much in terms of monthly payments. And few people can afford houses now. And so home buying is tanking. Home builder confidence is at a 10-year low. Mortgage demand is through the floor. Nobody's refinancing at these rates. So you got that sector just tanking. Meanwhile, another mini bubble that had blown up over the past few years was car loans.
Yeah.
And now the interest rate on car loans is up to like 10% in a lot of cases. So used car demand and new car demand, they're both falling dramatically. And there's apparently a wave of defaults coming in the auto market. So it goes on and on. There are a lot of sectors that are already in recession for all intents and purposes. And I think there's a decent chance they pull the rest of the economy down in the coming year, which presents the central banks with a real dilemma, really, right? Because they know they have to keep interest rates high to head off another bout of inflation. Because if inflation picks back up, in other words, if prices start to rise again, then there's no credibility at the central bank level at all. It's just over for these guys. So they want to stay tight as long as possible, but they're tightening in the face of an economy that has really headed south, and so it'll be interesting to see which mistake they make in 2023, because there is no good solution for the central banks. They've messed things up so much, but they'll either tighten too much and give us a something more depression-like than a recession, or they'll capitulate and loosen too soon and send us right back into some kind of inflationary spiral. And that's it. Those are their choices. So I suspect that they'll make the first mistake and then the second mistake. In other words, they'll stay tight for too long. The economy will really tank. And then the central banks will go nuts and start cutting interest rates back into negative territory. You totally want to own gold and silver and mining stocks while all that's going on.
Well, I certainly think that certainly seems to me to be one of the few places to go, at least to have some liquid assets. And then, also there's, as you point out, trillions of dollars of paper wealth that is going to money heaven as well. And, capital is being, if you call it capital, I don't really call it capital. Capital is not created out of the, keystrokes of a computer like Bernanke thought. Capital is really what isn't consumed, and money that isn't consumed. But no, there's so much more, John. One of the thoughts that I was really shocked when David Stockman said on this show, and then Daniel DiMartino Booth followed up right after that, the idea that there's not going to be any pivot anytime soon. Now, that's going back 6 months or so ago when David said that. And everybody seems to be anticipating the next pivot. And Powell is saying, and every time they anticipate it, it seems to tick Powell off. And he says, no, we're going to stay tight for longer. We got to lick this thing. And, Daniel DiMartino Booth is talking about a 5% on the federal funds, 5.5% or so, means we still have a ways to go if they're going to get there. With 30 seconds left, John, what are your thoughts? Are they going to stick with it? How long will they stick? They'll stick with it until they go too far.
I think they would like to stick with it, but what they're looking at is a massive stock market crash and a massive housing crash at the same time. Yeah. And I don't know how long they can stick with that. There's no immediate election coming up, which gives them a little bit of leeway. But, 5% Fed funds rate is probably an 8% 30-year mortgage, right?
My goodness,
so that's the end of the housing market. If car loans are 12%, that's the end of the used car market. So and as you said, the stock market has tanked already. We've already lost $11 trillion of fictitious stock market wealth in the U.S. in the past year. Yeah. And that gives us the wealth effect in reverse, where your stocks are down, you feel dumb and poor all of a sudden, and you stop spending money. So wherever you look, it's a recession.
Yeah, well, it's certainly, and wherever you look, where can you go for safety and a safe haven? And it could very well be today's market. Gold and silver blast-off might be the start of more and more people recognizing what that safe haven is. John, we'll have to leave it go at that. Thank you so much for filling in with Lyn Alden. You always do such a great job. It's really great having you. We'll look to do it again sometime soon.
Thanks, Dave.